There's a quiet truth about retirement that most people don't discover until it's too late. It's not just about how much you save, it's about what you choose to do with that money once you get there. Over the years, after studying countless retirement journeys, some inspiring, others heartbreaking, I've noticed a pattern that's hard to ignore. The retirees who struggle financially are often not the ones who earn the least. And the retirees who thrive aren't always the ones who earn the most. The real difference? The decisions they make with their money, especially the assets they choose to buy. Because retirement isn't just a finish line, it's a long, delicate phase where every financial decision either strengthens your foundation or slowly erodes it. And today, I want to walk you through something that could genuinely change how you approach your retirement future. There are 8 specific assets that quietly separate financially secure retirees from those constantly worrying about money. 8 traps that look harmless, sometimes even attractive, but over time can drain wealth, limit flexibility, and create unnecessary stress. And if you understand these, truly understand them, you'll avoid mistakes that cost people not just money, but peace of mind. Let's start with one that surprises almost everyone. 1. The illusion of timeshares. On the surface, a timeshare feels like a dream, a guaranteed vacation every year, a place that's yours, a commitment to relaxation and family memories. For many retirees, it feels like a reward after decades of hard work. And emotionally, it makes sense. You're not just buying a property, you're buying experiences, traditions, something to pass down. But here's where reality quietly steps in. Timeshares are not assets in the way most people think. They don't grow in value. They don't provide meaningful flexibility. And more importantly, they come with ongoing obligations that don't go away. Maintenance fees, special assessments, exchange costs, annual dues. These aren't optional. They follow you year after year, regardless of whether you use the property or not. And the most painful part, if you ever decide you no longer want it, getting out can feel nearly impossible. The resale market is notoriously weak. Many owners end up trying to give their timeshares away, sometimes even paying someone just to take over the contract. Now contrast that with how financially confident retirees approach travel. They value flexibility. They choose where they want to go, when they want to go, and how long they want to stay without being tied to a fixed location or schedule. They keep their money liquid, available, working for them. Because in retirement, freedom isn't just about time, it's about options. And locking yourself into a long-term obligation, especially one that doesn't appreciate, is often the exact opposite of that. 2. High-fee annuities, the comfort that costs too much. Now let's talk about something that sounds incredibly reassuring, but often comes with hidden complexity. Annuities. If you've ever sat down with a financial advisor or attended a retirement seminar, you've probably heard the pitch, guaranteed income for life. And on the surface, that sounds exactly like what retirement should provide: certainty, stability, peace of mind. But here's where things get complicated. Not all annuities are created equal, and the ones that tend to be heavily marketed, especially to retirees, often come with layers of fees, restrictions, and limitations that aren't immediately obvious. High-fee annuities, particularly variable annuities with income riders, can quietly eat away at your returns over time. You might be paying for mortality and expense fees, administrative costs, investment management fees, rider fees for guarantees. And when you add it all up, it's not uncommon to see total annual costs exceeding 2% or even 3%. That might not sound like much at first glance, but over 10, 15, or 20 years, it becomes a massive drag on your portfolio. And then there's the issue of liquidity. Many of these contracts come with surrender periods, sometimes lasting 7 to 10 years, where accessing your own money triggers significant penalties. So if your situation changes, if you need flexibility, if opportunities arise, you're stuck. I remember a case that still sticks with me. A woman came in with most of her retirement savings tied up in a variable annuity. She had been sold the idea of guaranteed income, but here's the twist. She didn't even need the income. Between her pension and Social Security, her basic expenses were already covered. Her real goal? To leave something meaningful behind for her son. But instead of having a flexible, growth oriented portfolio aligned with that goal, her money was locked into a product designed for income she didn't require. That's the danger. It's not just about whether a product is good or bad, it's about whether it fits your life. And more often than not, high fee annuities are sold, not designed, which is why thoughtful retirees tend to lean towards simpler, lower cost strategies that give them control, clarity, and flexibility. 3. Whole life insurance. When protection becomes a burden. Now let's shift to something that often carries a sense of security, something that sounds responsible, even wise. Whole life insurance. At its core, life insurance serves an important purpose. It protects your loved ones. It provides financial support when it's needed most. But somewhere along the way, whole life insurance began to be marketed not just as protection, but as an investment strategy. And that's where things start to get blurry. Because while whole life policies do build cash value over time, they're often misunderstood, especially when purchased later in life. Here's the reality. These policies take years, sometimes decades, to really gain meaningful value. And when retirees buy them in their 50s, 60s, or beyond, they simply don't have the time horizon for that growth to fully develop. Meanwhile, the premiums remain high, the structure is complex, and the flexibility is limited. So instead of serving as a helpful financial tool, the policy becomes an ongoing obligation, a commitment that drains cash flow rather than supporting it. Financially confident retirees tend to approach this differently. They separate insurance from investing. They use insurance for protection when it's needed and nothing more. And when it comes to growing wealth or preserving assets, they rely on tools that are transparent, flexible, and aligned with their timeline. Because in retirement, simplicity isn't just convenient, it's powerful. 4. Rental properties, the dream that turns into a job. Now, this one might challenge a belief that's deeply ingrained: real estate. For many people, owning rental property feels like the ultimate retirement strategy. Passive income, tangible assets, long-term appreciation. It sounds ideal, but the reality is often very different because rental properties are rarely as passive as they seem. There are tenants to manage, repairs to handle, vacancies to navigate, unexpected costs that show up at the worst possible times, and perhaps most importantly, there's the time and energy required to keep everything running smoothly. What starts as an investment can quickly turn into a second job. And for retirees who are supposed to be stepping into a more relaxed, flexible phase of life, that's not always a trade-off worth making. I remember speaking with a client who owned a property across the country. On paper, it looked like a solid investment. But when we broke it down, the numbers told a different story. She had about $550,000 in equity tied up in the property and was generating roughly $15,000 per year in net income. At first glance, that might seem reasonable, but when you think about it differently, to generate $15,000 annually from a diversified investment portfolio, you'd typically need somewhere between $300,000 and $375,000, depending on your withdrawal rate, which means she had significantly more capital tied up for the same or even lower income. And that doesn't even account for the stress, maintenance, and long-distance management involved. That's the key difference. Financially secure retirees don't just look at income, they look at efficiency. They ask, is this the best use of my money? Is the return worth the effort, risk, and time? And often, the answer leads them towards simpler, more scalable investments that allow them to enjoy retirement, not manage it. 5. High yield bonds. When more income comes with hidden fragility. At some point in retirement, the conversation almost always shifts to income. How do I generate enough cash flow without taking too much risk? And that's exactly where high yield bonds start to look appealing. They promise higher interest payments, bigger payouts, a way to boost income without stepping fully into the volatility of stocks. On paper, it feels like a smart middle ground, but here's the part that doesn't always get the attention it deserves. High yield bonds are often referred to as junk bonds for a reason. They're issued by companies with weaker financial positions, companies that have a higher likelihood of defaulting on their debt. And when do those defaults typically happen? At the worst possible time, during economic downturns, exactly when retirees are relying on that income the most. So, what initially looked like a steady stream of cash flow can suddenly become unreliable or disappear altogether. And unlike stocks, where volatility is expected and often temporary, bond defaults can lead to permanent losses. That's the risk many people underestimate. Now, this doesn't mean high yield bonds are inherently bad. They can have a place in a well-structured portfolio, but they're not something you set and forget. They require careful monitoring, diversification, and an understanding of credit risk. Financially confident retirees take a more balanced approach. They don't chase yield for the sake of income. Instead, they focus on building a system where each part of the portfolio plays a clear role. Stocks provide long-term growth. High-quality bonds provide stability and liquidity. And together, they create a structure that supports both income and resilience. Because in retirement, it's not just about how much you earn, it's about how reliable that income is, especially when the unexpected happens. 6. Structured products, complexity that works against you. Now let's talk about something that often sounds incredibly sophisticated: structured products. These are often marketed with phrases like market upside with downside protection, participate in gains while limiting losses. And if you're someone who wants growth but fears market volatility, that pitch can feel almost perfect. But here's the truth that doesn't always get explained clearly. Structured products are complex by design. They combine derivatives, bonds, and various financial instruments into a package that's difficult to fully understand, even for experienced investors. And when something is hard to understand, it becomes harder to evaluate, harder to question, and easier to accept without fully seeing the trade-offs. Because there are always trade-offs: limited upside caps, hidden fees, liquidity restrictions, and conditions buried deep in the fine print that determine how and when you actually benefit. In many cases, these products are engineered in a way that favors the institution, creating them more than the investor buying them. That's not a conspiracy. It's just how the incentives are structured. Now think about this from a retirement perspective. You've spent decades building your wealth. Do you really want to place it into something you can't easily explain? Something you can't adjust or exit without consequences? Financially confident retirees tend to move in the opposite direction. They prioritize clarity over complexity. They choose investments they can understand, track, and control. They accept that markets will rise and fall, but they'd rather face that reality directly than hide behind a product that promises protection, but delivers limitations. Because simplicity isn't a weakness, it's a strategy. And in retirement, it's often one of the most powerful advantages you can have. 7. Vacation homes, when a dream becomes a financial anchor. Now let's talk about something deeply emotional: the idea of owning a vacation home. It's easy to picture: a peaceful getaway, a place for family gatherings, a retreat where memories are made year after year. And for many retirees, it feels like the perfect reward after a lifetime of hard work. But here's where expectations and reality often diverge. Owning a second home comes with ongoing costs that are easy to underestimate: property taxes, insurance, maintenance, utilities, repairs that don't wait for convenient timing. And those costs continue, whether you're using the property or not. Then there's the question of usage. Many people imagine they'll spend months there each year, but in reality, life gets busy, travel plans change, health, family, and priorities evolve. And what often happens is that the property sits unused for long stretches while still costing money every single month. Financially confident retirees approach this differently. They ask a simple but powerful question: do I want ownership or do I want experience? Because those are not the same thing. Owning a property gives you responsibility, renting gives you freedom, the ability to choose different locations, different environments, different experiences without being tied down. And often, when you run the numbers, renting high quality vacation homes or luxury stays when you actually want them ends up being more cost effective than owning a property you only use part of the time. Plus, there's something else that matters in retirement: flexibility. The freedom to adapt your lifestyle as your needs and desires change. A vacation home can quietly limit that flexibility, turning what was meant to be a source of joy into something that feels restrictive. 8. Actively managed funds, the silent wealth drainers. Now let's talk about something that doesn't feel risky at all, but can quietly erode your wealth over time. Actively managed funds. These have been around for decades. They're familiar, widely recommended, often presented as a way to beat the market with professional expertise. And that sounds reasonable. After all, who wouldn't want experienced managers making decisions on their behalf? But here's what the data and real-world outcomes consistently show. Most actively managed funds fail to outperform the broader market over the long term, and yet they still charge higher fees, management fees, trading costs, internal expenses that aren't always obvious but compound over time. And those costs matter more than most people realize, because every percentage point you pay in fees is a percentage point that's no longer working for you. Over 10, 15, or 20 years, that difference becomes enormous. It's not just about performance, it's about what you keep. Financially confident retirees understand this deeply. They don't try to outguess the market. They focus on capturing market returns efficiently. They use low-cost index funds and diversified strategies that minimize fees, reduce tax drag, and keep more of their money compounding over time. Because the goal isn't to win a short-term game. It's to build a sustainable, long-term system that supports your life. And often, the simplest approach ends up being the most effective. What wealthy retirees do differently. Now that we've walked through all 8 of these asset traps, something important starts to come into focus. It's not just about what financially secure retirees avoid. It's about how they think, how they approach decisions, how they structure their financial lives, because there's a mindset behind all of this. They don't chase flashy promises. They don't get pulled in by emotional marketing. And they don't confuse complexity with sophistication. Instead, they focus on a few core principles that guide everything they do. They value simplicity. If an investment is too complicated to understand, they step back. They ask questions. And if the answers aren't clear, they move on. They prioritize flexibility. They want their money accessible, adaptable, ready to respond to changes in life. Because retirement isn't static, it evolves. They think in terms of total return, not just income. They understand that income can come from multiple sources: dividends, interest, and even strategic withdrawals. So they don't chase high yields at the expense of long-term stability. They focus on cost efficiency because they know that controlling what they can, like fees and taxes, has a powerful impact over time. They pay attention to opportunity cost. Every dollar they invest is a decision, and they constantly ask, is this the best possible use of this money? And perhaps most importantly, they surround themselves with the right guidance, not people who push products, but people who align strategies with goals, people who understand that retirement planning isn't about selling, It's about designing a life. If there's one thing to carry with you from all of this, it's this. Retirement success isn't about avoiding every mistake. It's about avoiding the big ones, the ones that quietly lock up your money, the ones that drain your resources over time, the ones that limit your ability to adapt, grow, and enjoy the life you've worked so hard to build. Because at the end of the day, retirement isn't just a financial phase, it's a life phase. And the goal isn't just to have enough, it's to feel secure, to feel free, to feel in control. And the decisions you make, especially around where your money goes, play a bigger role in that than most people realize. There's a moment that happens quietly for many retirees. It doesn't make headlines, it's not dramatic, but it changes everything. It's the moment when they realize, this decision, I can't undo it. Maybe it's money locked into a product they don't fully understand. Maybe it's a property that's become more of a burden than a benefit. Maybe it's fees slowly eating away at their savings, so gradually that they didn't notice until years had passed. And in that moment, the stress doesn't come from the market, it comes from lack of control. Because retirement, more than any other phase of life, demands flexibility. Life shifts, health evolves, priorities change, family needs arise, opportunities appear, and when your money is tied up, restricted, or underperforming, you feel it, not just financially, but emotionally. The difference isn't luck, it's awareness. When you step back and look at the bigger picture, something becomes very clear. The retirees who thrive didn't just get lucky, they made intentional decisions. They avoided traps, not because they were smarter, but because they were more aware. They asked better questions. They slowed down before committing. They didn't chase what sounded good. They focused on what actually worked. And most importantly, they understood that retirement isn't about maximizing returns at all costs. It's about building a system that supports your life consistently, reliably, and without unnecessary stress. A different way to think about money in retirement. What if you approached your retirement differently? Not from a place of fear, not from a place of chasing the next best opportunity, but from a place of clarity, where every decision answers three simple questions. Does this give me more control or less? Does this increase my flexibility or reduce it? Does this move me closer to the life I want or further away? Because when you filter your financial decisions through that lens, something powerful happens. You stop reacting, and you start designing a retirement that isn't just about numbers, but about how those numbers support your freedom, your peace of mind, and your ability to live fully. The quiet power of simplicity. There's a reason why financially secure retirees often keep things simple. It's not because they lack options. It's because they've learned what truly matters. They've seen how complexity can hide costs, how restrictions can limit choices, how emotional decisions can lead to long-term consequences. And so they simplify, not as a shortcut, but as a strategy. They build portfolios they can understand. They choose investments they can adjust. They create systems that work with their lives, not against them. And over time, that simplicity becomes a source of strength. Because when things are clear, you make better decisions. When things are flexible, you adapt more easily. And when your money is aligned with your life, everything feels more stable. Imagine this instead. Imagine waking up in retirement knowing that your money is working for you, not locked away somewhere you can't access. Your income is stable, not dependent on risky promises. Your lifestyle is flexible, not tied to obligations you can't escape. And your decisions are intentional, not driven by pressure, fear, or confusion. That's what all of this is really about, not avoiding every mistake, but creating a foundation strong enough to support the life you actually want to live. If there's one thing I hope you take away from this, it's this. Most financial mistakes in retirement don't feel like mistakes in the moment. They feel like opportunities. They feel like smart decisions. They feel like the right thing to do until time reveals the truth. And by then, it's often harder to adjust. But now you're aware. You can see the patterns. You understand the difference. And that puts you in a completely different position than most people. Because awareness leads to better decisions, and better decisions lead to better outcomes. So, as you think about your own retirement, whether it's right around the corner or still years away, take a moment. Look at where your money is, look at how it's working, and ask yourself honestly, is this helping me build the life I want or quietly working against it? Because the goal isn't just to retire, it's to retire well, with confidence, with clarity, and with the freedom to live life on your terms. Thanks for being here and for taking the time to think about this at a deeper level. I'll see you in the next one.